In Berkshire Hathaway's 2005 annual report, Warren Buffett outlined a stinging attack on the billion-dollar hedge fund industry, suggesting that these expensive helpers do little to help investors, but charge substantial fees, or frictional cost as Warren Buffett terms it, that erodes returns to investors in hedge funds. These helpers include financial planners, institutional consultants, fund managers, private equity managers, and even stockbrokers who encourage the churning of accounts, the frequent buying and selling of stocks and other financial products in order to charge more fees. As Warren puts it, the burden of paying helpers may cause American equity investors overall to earn only 80% or so of what they would earn if they just sat still and listened to no one. What Warren Buffett means by sitting still and listening to no one is passive investment through a low-cost index fund like the Vanguard S&P 500 index fund, which doesn't seek to actively pick and choose stocks, but rather passively imitates the S&P 500 index. It's the reason why index funds like the Vanguard S&P 500 is able to charge a low cost. They don't have to pay for a pricey active fund manager. Following the scathing critique of the hedge fund industry, Warren Buffett put his money where his mouth is and placed a bet on Long Bets, a website funded by Amazon's Jeff Bezos that allows individuals to place long-term bets to any investment professional. The bet goes as follows. Over a 10-year period commencing on January 1st, 2008 and ending on December 31st, 2017, the S&P 500 will outperform a portfolio of funds of hedge funds when performance is measured on a basis net of fees, costs, and expenses. Warren backed up his claim with $500,000 to anybody that was willing to challenge his claim. Now, you would assume that many hedge fund managers would swarm at this opportunity, since if successful, your name would make headlines around the world. Legendary hedge fund manager slays the Oracle of Omaha. You can't pay for advertising like that. But nope, there was silence, until Ted Seides, a co-manager at Protégé Partners, took up Warren Buffett's challenge. Now, Ted Seides and Protégé Partners wasn't just a regular hedge fund. Protégé Partners is a funds of funds, meaning they are a hedge fund that invests in other hedge funds. So they should be an expert on evaluating which hedge fund managers are the real deal, since that's what they're paid for. Funds of funds typically charge a 1% fee on top of the fees that the hedge fund charges. There's a long list of fictional cost providers in the investment game. Both Warren Buffett and Ted Seides decided that their $500,000 wager would benefit a charity. If Warren Buffett won, then the Girls Incorporated of Omaha will be in for a very pleasant surprise. If Ted Seides wins, then the Friends of Absolute Return for Kids walks off with a $1 million pot. Warren chose the Vanguard S&P 500 Index Fund to represent the S&P 500, and Ted Seides chose 5 fund-of-fund hedge funds that invested in over 100 different hedge funds, so no one hedge fund results would bias the overall return of the hedge fund basket. Now, to understand why Warren Buffett is so suspicious of hedge funds' ability to beat the S&P 500, you have to understand the fee structure of many hedge funds. Typically, hedge funds charge what is known as the 220 fee structure, meaning that they charge a 2% fixed fee on money managed, regardless if they actually make any money for their clients. On top of the 2% fixed fee, hedge funds typically charge an additional 20% performance fee on any profits made. This is a typical fee structure for hedge funds, but it varies hedge fund to hedge fund. Hedge funds managed by star hedge fund managers can command even higher fees. On top of the 220 fee charged by the hedge funds of funds like the 5 selected by Ted Seides typically charge an additional 1% in fees. I suppose it's to pay for diversification and their supposed ability to pick winning hedge fund managers. Now, it's all these fees on top of fees that make Warren Buffett skeptical that returns generated by hedge funds over the long term and after all their fees can beat the returns of a low-cost passive index fund. Warren doesn't doubt that there are hard-working, intelligent people working at hedge funds. However, the hefty fees charged by hedge funds stack the deck against any hedge fund investors. Their IQ will not overcome the cost they impose on investors. So what are the results? I'm sure you're all asking in eager anticipation. Well, the bet still has the rest of 2017 to go, but as of the end of 2016, it's not looking good for Ted Seides and his basket of hedge funds. Warren Buffett and Ted Seides agreed not to publicly name the funds of funds that Ted Seides chose. I'm guessing it's to protect the hedge funds in case the results are too embarrassing. Gain to date from the start of the bet beginning 2008 to the end of 2016. Fund of Fund A returned 8.7%, Fund of Fund B returned 28.3%, Fund of Fund C returned 62.8%, Fund of Fund D returned 2.9%, and fund-of-fund E returned 7.5%. And what of the lowly S&P 500 index fund? It returned a whopping 85.4%, easily besting all 5 funds of funds. In total, the S&P 500 index fund returned 7.1% compounded annually, while the 5 funds of funds returned only 2.2% compounded annually. As Warren puts it, $1 million invested in those funds would have gained $220,000. The index fund, meanwhile, have gained $854,000. Definitely not a small difference. Warren Buffett goes on to estimate that over the 9-year period, roughly 60% of all gains achieved by the 5 funds of funds were diverted to the 2 levels of managers. And that's the crux of the problem with hedge funds and other helpers: high fees. Thanks for watching. Please subscribe for more fascinating economic documentaries. It's a great free way to support the channel.